Most investors believe that if they have a lump sum of cash, they should spread it out over time, a little each month, to reduce the risk of buying right before a crash. It feels safer, it feels smarter, it's called dollar cost averaging, and almost every financial guru on YouTube swears by it. But here's the truth that Vanguard's 95-year study revealed. If you're investing for the long term, dollar cost averaging is mathematically inferior 2/3 of the time. You are literally giving away free returns out of fear. And the data is so clear that even the most respected researchers say that the only reason to dollar cost average is to make you feel better, not to make you richer. If you stay until the end of this video, you'll see the exact historical data from 1926 to 2026, the specific market environments where each strategy wins, and the simple decision framework to choose the right approach for your situation. You'll also learn a hybrid strategy that gives you the best of both worlds, and why 2026's unique market conditions make this decision more important than ever. My name is your name, and today we're going to settle the oldest debate in investing. Let me start with a story that will make you question everything you've been told. In early 2024, two friends, Mike and Sarah, each received a $50,000 inheritance. Mike was nervous about the market being at all-time highs. He decided to dollar cost average $5,000 a month for 10 months. Sarah took the lump sum approach, all $50,000 invested on day one. Over the next 12 months, the S&P 500 rose 17%. Sarah's lump sum investment grew to $58,500, a profit of $8,500. Mike's first $5,000 grew for 10 months, his second for 9 months, and so on. His total profit was about $4,200, just half of Sarah's. Mike paid $300 for the peace of mind of dollar cost averaging. That's not a strategy. That's a tax on fear. Now, I'm not saying dollar cost averaging is always a mistake. In a falling market, DCA protects you from catastrophic loss. But in a rising market, which happens about 75% of the time, DCA leaves you trailing. The key is to know which environment you're in. And in 2026, the evidence suggests we're in a rising market with some volatility. The 95-year data, what Vanguard discovered. Asterisk. Vanguard analyzed nearly a century of market data from 1926 to 2021, and the results were clear. Across US, UK, and Australian markets, lump sum investing outperformed dollar cost, averaging roughly 2/3 of the time. More specifically, lump sum investing beat 12-month DCA in 68% of rolling 10-year periods. The average outperformance was a staggering 2.3% annually. On a $100,000 portfolio over a decade, that's over $23,000 left on the table. Why does lump sum win? Because the market has a long-term upward bias. It goes up more often than it goes down. By investing all your money immediately, you capture the full risk premium of the market. Every day your cash sits on the sidelines is a day you're not earning returns. The opportunity cost of waiting is real, but here's the nuance that most YouTube videos ignore. Your lump sum wins most of the time, but when it loses, it can lose big. In the worst 5% of outcomes, retiring in 1929 or 2000, dollar cost averaging would have protected you from some of the worst losses. So the choice is not about which strategy is mathematically superior. It's about your tolerance for the worst-case scenario, the 2026 market environment. Where are we now? Asterisk, before you decide how to invest a lump sum, you need to understand the current market. In 2026, Wall Street is overwhelmingly bullish. Goldman Sachs expects 12% earnings growth in 2026 and 10% in 2027, with the S&P 500 index's price-to-earnings multiple held near its current level of 21 times. JP Morgan has raised its 2026 S&P 500 target to 7,600 from 7,200, boosted by AI and tech earnings, lifting its EPS forecast to $300 from $315. Morgan Stanley's top strategist, Mike Wilson, has raised his year-end 2026 target to 8,000 and set a mid-2027 target of 8,300. And veteran analyst Ed Yardeni has raised his S&P 500 target for 2026 to 8,250, saying he continues to believe in the resilience of the economy and earnings. But here's the warning that every bull market has. Goldman Sachs also flagged that a 10% stock market correction is the biggest risk to the economy in 2026. Morgan Stanley's Wilson says this year's pattern resembles last year's early warning signals, and he's been calling for a pullback that appears to be nearing its later stages. 10Cap co-founder Jason Todd is cautioning that 2026 could see a 10% market correction driven by central bank actions. And Goldman Sachs CEO David Solomon told investors that it's likely there'll be a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. So what's the conclusion? The market outlook is positive, but not without volatility. We're likely to see pullbacks, maybe 10% corrections, but the long-term trend remains upward. That's exactly the environment where lump sum investing is most powerful, because even if you invest at the top of a correction, you have time to recover. The Fed factor, interest rates, and market momentum. One of the biggest drivers of market performance in 2026 is the Federal Reserve. The consensus has shifted dramatically. Ed Yardeni of Yardeni Research says a rate cut in 2026 is essentially off the table, citing reaccelerating inflation, 5 consecutive years above the Fed's 2% target, and the inflationary impact of the AI infrastructure build-out. Goldman Sachs expects PCE inflation to hover near 3% through 2026, well above the Fed's 2% goal, and has delayed its forecast for the final 2 rate cuts to December 2026 and March 2027. Bank of America has gone even further, removing its 2 2026 rate cuts entirely and pushing them to July and September 2027. Higher for longer interest rates typically create headwinds for stocks, but they also signal a strong economy. Corporate earnings are robust. The Wall Street consensus for S&P 500 earnings growth sits at 21.8% for calendar 2026. So the underlying engine of the market is strong, even if rate cuts are delayed. For the lump sum versus DCA decision, this environment suggests that the longer you wait to invest, the more you risk missing out on earnings-driven gains. But it also suggests that volatility will persist, so a pure lump sum approach requires emotional fortitude. The psychology of DCA. Why it feels so good. Let me be honest. Dollar cost averaging is not about math, it's about behavior. Studies show that DCA reduces the anxiety of market timing and helps investors stay committed to their long-term plans. It removes emotional decision-making, the tendency to buy after strong rallies and sell after declines. DCA converts volatility from an obstacle into fuel. You stick to a consistent plan and stop being a gambler. If you know yourself, and you know that you will panic and sell if the market drops 20% right after you invest a lump sum, then dollar cost averaging is the right strategy for you, not because it maximizes returns, but because it prevents you from making a catastrophic behavioral mistake. The worst investment decision is not lump sum versus DCA. It's selling at the bottom and never getting back in. DCA can prevent that. But if you have the discipline to hold through volatility, the data overwhelmingly favors lump sum. The hybrid strategy, the best of both worlds. This is what I do and what I recommend to most of my clients. Don't choose between lump sum and DCA, do both. Take your lump sum and divide it into 3 parts. Invest 1/3 as a lump sum immediately. This gets you in the game and captures any upside. Then set up a dollar cost averaging schedule for the remaining 2/3 over the next 6 to 12 months. This protects you from the worst-case scenario of investing everything right before a crash. And you keep the remaining cash in a high-yield savings account earning 4 or 5% while you DCA. You're not losing much to inflation. Let me give you a concrete example. You have $60,000. You invest $20,000 immediately. You set up automatic monthly investments of $5, top for the next 8 months. Over that period, the market goes up 10% and then pulls back 5%. Your lump sum captures the initial gain. Your DCA buys the dip. You come out ahead of both pure strategies. This hybrid approach reduces regret and gives you psychological peace. The worst-case scenario. What if you invest at the top? Asterisk, let me address the fear that keeps people up at night. What if you invest a lump sum right at the top of a market peak just before a crash? History shows that even in the worst cases, the market recovers. After a drop of more than 15%, the median 12-month forward return has been over 20%. After the low point, in 8 U.S. market downturns of more than 20%, equities delivered a 51% forward return after 1 year on average, and a 3-year return of 82%. Even after a 10% correction, the median 1-year return of the S&P 500 since 2008 has been 18.1% compared to an average annual return of 9.4%. The worst-case scenarios are painful in the moment, but they are wealth-building opportunities for those who hold. If you had invested a lump sum at the peak of the 2007 market, you would have lost 50% of your money by 2009. But if you held, by 2014, you would have been ahead. By 2020, you would have nearly tripled your money. Time in the market beats timing the market, even when your timing is terrible. Asterisk, the retirement account loophole. Why the deadline matters. Here's a practical tip that most people miss. If you have cash that you want to invest in a Roth IRA or traditional IRA, you have a unique advantage. For the 2026 tax year, you have until April 15, 2027 to make your IRA contribution. That's over 15 months of flexibility. This means you can use a hybrid strategy inside your IRA. You can contribute a lump sum early in 2026 and then DCA the rest of your contribution over the subsequent months. Or you can wait for a market pullback. The extended deadline gives you options that a taxable brokerage account does not. For example, if you've budgeted to contribute $7.500 to your Roth IRA for 2026, the new limit under Secure 2.0, you could contribute $2,500 in January, $2,500 in June, and $2,500 in December. That's DCA inside a tax-advantaged account. Use the deadline to your advantage. The tax refund play. How to invest your windfall wisely. April 2026 is tax season. Many of you will receive tax refunds. The average refund is around $20,100. What should you do with it? If you follow the data, you should invest it as a lump sum because markets historically rise after tax season. But if you're anxious, use the hybrid approach. Invest 50% immediately and DCA the remaining 50% over 3-6 months. And for goodness sake, don't leave it in your checking account earning 0.01% while you decide. The 401 automatic advantage. Why? You're already DCAing. Here's something most people don't realize. If you have a 401 and you contribute every paycheck, you are already dollar cost averaging. You don't need to choose between strategies for your regular contributions. They are automatically DCA'd. The lump sum versus DCA debate only applies when you have a large sum of cash that is not already in the market: an inheritance, a bonus, a home sale proceeds, a tax refund. For your regular paycheck contributions, just keep doing what you're doing. The market's long-term trend will reward your consistency. The real question, not which strategy, but which investor. At the end of the day, the choice between lump sum and DCA comes down to one question: who are you? If you are a disciplined, long-term investor who can stomach a 20% drawdown without selling, the data says you should invest your lump sum immediately. You will come out ahead about 2/3 of the time. If you are someone who will panic and sell at the bottom, you should dollar cost average, not because it will make you richer, but because it will keep you from making yourself poorer. I've seen both types. I've seen clients who invested $500,000 at the peak of 2007, held through the crash, and are now multi-millionaires. I've also seen clients who invested $100 at the peak of 2021, panicked and sold at the bottom of 2022, and are now still in cash, waiting for the right time. The strategy that works is the one you can stick with. Asterisk the 2026 challenge. Valuations are high, but earnings are strong. Let me give you my honest take on 2026. Valuations are high. The S&P 500 is trading at around 21 times forward earnings. That's above the historical average of about 15-16. So a correction is possible, even likely. But earnings are also strong. The Wall Street consensus for S&P 500 earnings growth sits at 21.8% for calendar 2026. That's not a bubble. That's real growth driven by AI infrastructure and consumer resilience. If you have a lump sum to invest, I recommend the hybrid approach: 50% now, 50% DCA over 6 months. That gives you exposure to the upside while protecting you from the worst of a potential correction. And if a correction comes, you'll have cash to buy the dip. A final story: the investor who waited too long. I want to tell you about a client named Robert. In 2019, Robert inherited $200,000. He was terrified of a market crash. He kept the cash in a money market account, waiting for the right time. The market went up 28% in 2019. He didn't invest. It went up another 16% in 2020. Despite COVID, he didn't invest. It went up 26% in 2021. He still didn't invest. By the time he came to me in 2023, he had missed out on over $100,000 in potential gains. He had paid the opportunity cost of fear. Robert finally invested his $200,000 in 2023 using a hybrid approach. In 2024, his portfolio grew 20%. He told me, "I wish I had done this years ago. I paid a fortune for the peace of mind of sitting in cash." Don't be Robert. Cash is not safe. It is losing value to inflation every single day. The stock market has risks, but the risk of not investing is greater. Your action plan? Do this today. Here's what you need to do in the next 24 hours. First, identify any lump sum cash you have sitting idle: inheritance, bonus, tax refund, home sale proceeds. Second, decide on your strategy based on your personality. If you can stomach a 20% drop without selling, lump sum. If you'll panic, hybrid or DCA. Third, if you choose hybrid, divide your lump sum into 3 parts. Invest 1/3 immediately. Keep the rest in a high-yield savings account while you DCA over 6 to 12 months. Fourth, set up automatic monthly transfers from your high-yield savings account to your brokerage account. Automate it so you don't have to think. Fifth, if you're investing in an IRA, use the extended deadline to your advantage. You have until April 15, 2027 to make your 2026 IRA contribution. Sixth, comment below. I'm investing my lump sum using GIS strategy. Tell me which strategy you're choosing. I'll reply to the first 100 comments. If this video gave you the data and the courage to invest, hit the like button. It helps others who are paralyzed by fear. Subscribe and turn on notifications. In the next video, I'm going to reveal the truth about paying off your mortgage early. Why it might be the worst financial decision you ever make, lump sum or DCA. The data says lump sum wins 2/3 of the time. But the best strategy is the one you can stick with through the inevitable volatility. Choose wisely. Then take action. Your future self is waiting. I'll see you in the next video.